Is it possible that a significant portion of your hard-earned retirement income could suddenly slip through your fingers? If you have ever felt a knot in your stomach, worrying that the government might take back your hard-earned old age security payments, you are certainly in good company. Every single year, a massive wave of Canadian seniors find themselves scratching their heads over the inner workings of the OAS recovery tax. There is a lot of anxiety out there about who is targeted, how the math is calculated, and what kind of prep work is required to shield your finances. Fortunately, there is a massive silver lining here. An overwhelming majority of retirees will cross the finish line without ever triggering this tax at all. However, if your financial picture involves growing revenue, strategic investment sales, upcoming withdrawals from a registered retirement savings plan, RRSP, or registered retirement income fund, RRIF, or if you simply choose to stay in the workforce after your formal retirement date, ignoring the mechanics of this system is a risk you cannot afford to take. Welcome to Canada Pension Hub, your premier digital space for clear, accurate, and completely reliable breakdowns of the Canada Pension Plan, CPP, Old Age Security, OAS, the Guaranteed Income Supplement, GIS, and the broader landscape of Canadian retirement benefits. Today, we are pulling back the curtain on the OAS recovery tax, the financial mechanism that almost everyone commonly refers to as the OAS Clawback. Over the course of this deep dive, we will break down exactly what this tax means, pinpoint who is vulnerable to it as we navigate 2026, show you precisely how the government calculates the math, and highlight the red flags you need to watch out for. More importantly, we are going to bust the most pervasive myths floating around out there so you can organize your retirement cash flow with total peace of mind. Let's lay down the foundational groundwork first. A lot of people mistakenly assume the OAS recovery tax arrives as a sudden, unexpected bill in their mailbox. That is not how it operates. Instead, it functions as a built-in repayment mechanism that only kicks into gear if your annual net income scales past a very specific, government-mandated limit. Because the baseline old age security program draws its funding directly from general federal tax revenues, the system is structurally designed to scale back. Essentially, the government requires higher-earning retirees to pay back a piece, or potentially all of their pension benefit, to ensure resources are distributed equitably. For the current payment distribution window, which calculates your eligibility based on the net income you brought in during the 2025 tax year, that official boundary line starts at exactly $93,454. Once your total net income steps over that specific marker, you enter the repayment zone, where you are required to return 15% of every dollar earned above that threshold. The ultimate impact on your wallet is entirely tied to your exact total earnings, alongside the total amount of OAS benefits you pull in. Because Ottawa adjusts these threshold numbers periodically to keep pace with economic shifts, making a habit of verifying the freshest statistics directly via official Government of Canada digital portals is always a smart move. Another element that regularly trips people up is the administrative timeline. The physical checks or direct deposits you receive from July of 2026 through June of 2027 do not look at your current 2026 earnings in real time. Instead, they are directly tethered to the financial realities documented on your 2025 tax filing. This creates a distinct lag effect. The money you made last year serves as the direct dial that tunes the volume of the benefits hitting your bank account this year. So, who actually finds themselves in the crosshairs of this recovery tax? The reality is that seniors whose retirement income relies exclusively on standard CPP distributions, baseline OAS payments, and modest personal savings will comfortably sit well below that fiscal line, meaning they will go their entire lives without ever encountering a clawback. The vulnerability increases significantly for retirees who are juggling multiple overlapping streams of income. If your financial portfolio features a mix of corporate workplace pensions, steady rental property revenues, taxable investment portfolios, substantial mandatory RRIF drawdowns, or active employment checks from a post, this also leads to a question that has been flooding our community forums lately. Has the federal government made any major moves to completely eliminate or fundamentally overhaul the OAS Clawback system for 2026? To give you the straight, unvarnished facts, as of right now, there have been absolutely no official government declarations outlining structural overhauls or an abandonment of the recovery tax system. It is completely normal to run into sensationalized headlines, viral social media commentary, or highly speculative online threads promising massive, dramatic transformations to your benefits. In the digital age, the safest course of action is to always cross-verify these dramatic claims against verified, official Government of Canada publications before altering your financial plans. Retirement policies absolutely shift over time, often introduced via federal budget updates or formal legislative amendments. But as a viewer, it is critical to separate verified legislative reality from online guesswork. If an actual legally binding reform is ever introduced by the government, you can rest assured that we will break down every single detail right here on Canada Pension Hub. With all of that in mind, what are the concrete, proactive steps you can take to manage your situation? First, make a habit of project mapping your anticipated net income well before the clock runs out on the active tax year. If you are staring down a massive upcoming RRIF liquidation, looking to sell off real estate or stock assets, or expecting any kind of significant lump sum windfall, take the time to calculate exactly how that influx of cash will interact with your total taxable income. Second, commit to maintaining highly organized, meticulous records of every single dollar flowing into your household. When you are pulling small amounts from a variety of different places, it is incredibly easy to lose track and underestimate your true cumulative income until it is too late. Third, if your financial framework is starting to look complex, do not hesitate to sit down with a certified financial planner or a licensed tax professional. These experts specialize in analyzing how distinct revenue streams collide and can help you structure your withdrawals to minimize unnecessary tax exposure. Fourth, treat your annual tax filing deadline as an absolute priority. Service Canada pulls data straight from your tax return to determine whether you owe a recovery tax, and filing your paperwork accurately and on time prevents frustrating processing bottlenecks or disruptions to your monthly payments. Ultimately, mastering the mechanics of the OAS recovery tax isn't about panicking or trying to dodge the system at all costs. It is about equipping yourself with complete clarity so that you are never caught off guard by unexpected changes. While the word clawback sounds incredibly intimidating on the surface, the reality is that the vast majority of Canadian seniors will never have to worry about it. For those who do cross the line, a solid grasp of the rules makes navigating retirement planning a much smoother experience. Always keep in mind that financial planning is deeply personal. Two neighbors of the exact same age can walk away with completely different OAS outcomes simply because their underlying income sources are structured differently. That is precisely why trying to compare your personal government benefits with what your friends or neighbors are receiving often leads to unnecessary confusion and worry. Looking forward, staying informed about inflation metrics, pension indexing updates, upcoming federal budgets, and evolving retirement policy debates will remain essential for every Canadian senior. While future administrations may propose adjustments to senior support frameworks down the road, any legitimate changes will always be rolled out through formal public announcements and standard legislative channels. Until that happens, the established OAS recovery tax frameworks remain the law of the land. To tie everything together, let's do a quick wrap-up of the essential takeaways from today's discussion. The OAS recovery tax only applies to retirees whose annual net income moves past the designated government threshold. For the payment window launching in July of 2026, the calculations are anchored to the net income reported on your 2025 tax documentation. The repayment rate is locked at a steady 15% on the earnings that surpass the limit, and exceeding the threshold does not mean an automatic forfeiture of your entire pension. Finally, there are zero verified announcements signaling changes or cuts to the clawback system for 2026, so always rely on confirmed government channels rather than wild internet rumors. We are incredibly grateful you chose to spend some of your valuable time with us today here at Canada Pension Hub. If this breakdown brought you clarity and helped ease your mind, please take a quick second to hit that like button, subscribe to our channel, and ring the notification bell. Doing that ensures you will never miss our latest updates on CPP, OAS, GIS, and the critical government policy shifts that impact Canadian seniors. We want to hear from you too. Have you ever had to navigate the OAS recovery tax in your own planning? Or are you currently trying to structure your income to stay below the line? Drop your perspectives, experiences, and questions in the comment section below. Your input helps shape our upcoming videos. Thank you so much for watching, take care of yourself, and we will see you in the very next update right here on Canada Pension Hub.